Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. It's time to have another conversation about the campaign by Saba Capital to requisition meetings with 7 listed investment trusts in the UK. The other day, we heard from Karen Braid, who is the chair of Keystone Positive Change. And in this episode, I'm going to be talking to Sue Inglis, who is the senior independent director at Baillie Gifford US Growth, ticker USA. I might begin, Sue, by asking you just to describe your background and how long you've been on the board and so on at this particular trust. I know your background was in corporate finance, but perhaps you could just fill us out on that first of all.
Yes, thank you, Jonathan. My background has been both as a lawyer and as a corporate financier. I was 30 years covering both those areas, focusing on the financial sector and in particular investment companies. So I've seen almost everything there is to see in the sector, I think, before Saba came along. And I moved to a plural career of non-execs in 2018, which was when Baillie Gifford US Growth was launched. So I joined the board on IPO.
Right. So you've done 7 years on the board and you are currently the senior independent director. So perhaps the first question I might ask you is, when did you first become aware of Saba's involvement in your company, and how has that relationship, if I can call it that, developed since then?
So we thought they were beginning to appear on our company register indirectly in 2023. The reason we weren't certain initially is because they were holding their interest through the total return swaps that they've got. So they weren't disclosing at that stage all of their holdings. And when we were certain they were on the register, we reached out to them to offer them a meeting in early 2024. And that was between the chair and Saba. And we also again reached out in November as well to offer a further meeting, which was with myself and the chair. So both of those meetings were friendly. There was no criticism coming from Saba regarding the trust, the board, the management, the strategy, the discount, the performance. They seemed comfortable holders, expressing an interest in both the having bought at the discount, but the underlying asset class as well. So it was a bit of a surprise to see their requisition and the tone of their requisition.
Right. So in those initial contacts, as you say, they were apparently friendly and indeed supportive. But presumably, with your background in corporate finance, you had some aware of what their history was and the nature of their business. I don't know if you ever come across Mr. Weinstein before. So you must have perhaps had some suspicions that they might be planning perhaps something less transparent.
Absolutely. And that was really one of the reasons why we wanted to meet with them in November. Because what seemed strange to us was that they were buying on narrowing discounts and getting towards levels which conventional discount players would not normally buy at. So we wanted to understand what their strategy and endgame was, because they were obviously becoming a significant holder in the trust. But unfortunately, out of that meeting, there was nothing useful to inform the board of their thinking at that stage.
So this definitely came as a bolt from the blue as far as you're concerned.
Yeah. The first warning really was probably 2 days before the requisitions, when they converted part of their holding into direct equities. So they were on the register to be able to serve the requisition.
Right. So can I ask you this, before we talk about the merits of what they're proposing now? If you had been advising them, would you have advised them to behave this way?
Absolutely not, to be honest. Yeah, I've done a lot of requisitions over my professional career, and I wouldn't have approached as a one-size-fits-all, because that's completely wrong for our sector. Each trust has its own personality, its own foibles, if you want. So you have to design any form of activity around the personality of the trust. That's the first point. Secondly, when I have done requisitions to change boards, I've always ensured that absolutely independent people have been put up for replacement by the shareholders promoting the change.
So I don't know how to put this, but basically you think this is an attempt to effectively hijack the trust and gain control of the assets. That seems to be now what they're proposing to do. Is that your interpretation?
That's certainly my interpretation of what they're up to.
And do you think you could have done more to forestall that?
It's something we've obviously been asking ourselves over the last few weeks. The criticism that they're levelling at us is the discount and where it got to. And we consulted with our shareholders consistently from the period we moved from trading at premium through to trading at the discount. And the feedback we were getting was, yes, we would like to see some buybacks, but we don't want to see a significant increase in the private company element of the portfolio. So we have approximately a third of the portfolio in private companies. And if we significantly increase that element, obviously the risk of the profile of the trust changes. So our buying back was really informed by the feedback we were getting from our shareholders. So I don't think we could have done more. Clearly, with the private companies in the portfolio, that does impose some restrictions on what we can do.
Absolutely. There's a limit to how many shares you can buy back without reaching your self-imposed limit on the private holdings, for example. But presumably, they've been using swaps to gain, if you like, voting exposure. Perhaps you could just explain to listeners how that works, how they can effectively only own, say, 5% of the shares, enough to requisition, but then have a sort of voting power that is more than that.
Yeah. So we're not certain on what terms their swaps have been entered into, but typically with a swap, the voting rights remain with the other counterparty, so the party on the other side to Saba on the swap. What we are seeing now is Saba is actually converting its swaps into direct holdings. So as at today, they hold approximately 20% now indirectly and 10% directly in Baillie Gifford US Growth. And what you are seeing is they're tending to do that on the other holdings as well. So we're assuming that they are going to convert their swaps into direct holdings to be able to vote them all. But they have certainly indicated that they will be voting all the stock they have an interest in.
Following up from that, they must have made these swap arrangements or bought these shares from somebody who was your shareholder before. So there has been obviously some of your share register who've been supporting what they've been doing directly or indirectly, or whether or not they knew where it was going ultimately.
You're absolutely right. Clearly, there have been sellers of the trust, and that's probably against the backdrop in particular of the really bad patch of performance we had over about 18 months in 2022 into early 2023. And Saba at that stage were the main buyer in town. However, we think that with the way that the performance has turned around, that there are, and we've seen evidence of other buyers, and that would come back naturally. As you knew, Jonathan, buyers often lag turns in performance. But with the strong performance that we've been enjoying over the last couple of years, and also the prospects for US generally, there are others wanting to remain patient and stay with the company in its current form.
So suppose they hadn't requisitioned these meetings but had remained in building up a significant stake and said to you, presumably at some point they would like to see some return of cash. If they had said that, what would you have responded to them?
We would want to do, and what we'd still want to do, is to work with them to take them off the register without disturbing the price. So typically what happens with your 1607s, your City of Londons, etc., once the discount falls below a certain level, they'll work with the managers and the brokers to slowly reduce their holdings and keep it a relatively stable share price. What we don't know here is what basis on which Saba would want to come out. We had hoped in the November meeting to understand what their sort of selling level, what discount they would sell at, but they gave us no information on that or no indication of what it would be.
And then before we get on to the substance then, just one final question about that. They've made some money from their shareholding in Baillie Gifford US Growth, clearly, though that will be reduced if they've been buying more shares recently or at a higher level. They've just been quite smart, haven't they?
They've taken advantage of the discount, yes, and the fact that they were the largest buyer around. So they've certainly made money, and yes, that's smart. The question is how they actually exit and realise that gain without destroying value. And I question whether they fully understand the implications of the private element of our portfolio, which you cannot easily sell and cannot do it in short order. So that does impact on how we can look to work with them in the future.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. So let's talk then about what you've said about this and how you intend to see them off. I mean, that clearly is your intention to see them off. What realistically can you do? We've got the vote coming up. You haven't had much time to prepare. You've got to get the vote out. Everybody has been saying that. We know that. And that's difficult with retail investors in particular. So what have you been doing and how confident are you you're going to see them off?
I'll deal with the last question first. We're very confident. I think it's probably worth highlighting that at our AGM last year in October, we had a 30% turnout, and that was without doing the sort of chasing we're doing now. That did not include Saba. That 38% also voted to re-elect all of the directors at that general meeting. So what are we doing? We're tackling both the wealth managers and institutions through our brokers and Baillie Gifford, but we're also engaging significantly with the retail platforms who are treating this now as a corporate action. So what that means is that even if you've opted out of receiving communications from your platform, you will still receive information on meeting and have the opportunity to vote. So that's the first helpful thing. Secondly, where the platforms have been helpful is typically they require 4 or 5 days before the proxy date for votes to come into the platform. The bigger platforms appear to be closing their voting off much closer to the proxy deadline. So it's giving the maximum opportunity for investors to vote. We've also got what we call a Section 792 information. That is a sort of technical term for whereby we ask the platforms under the Companies Act to provide us with the names and addresses of the investors in our trust. That's the only information we get. We don't get told shareholdings, etc. What that's enabled us to do, and we'll be posting later today, is a letter direct to all retail investors through the platforms. So again, trying to make sure that they're aware of the upcoming general meeting, the board's recommendation, and where they can find information. We've developed the website, so we've got a specific element on the website as well. And obviously, we're also engaging with press, analysts, etc., to try and get this story out.
Right. So it's interesting what you've been saying about the platforms, how they have responded. This could be a positive development for the investment trust sector if that remains the case in similar situations in the future. It's obviously been anomalous so far. Do you accept that there's any criticism of boards for not perhaps doing more to engage with their private shareholders in the past to make sure that they are plugged in and ready to vote when you might need them?
I've heard that accusation being cast around. The challenge that we have is that we cannot maintain a live register of who is holding our shares through the platforms. So the information we've got post the letter today, for example, we cannot use that information again. So if we were coming to the AGM and to do the same exercise again, we have to go through all the cost of requisitioning the information, then transporting it, posting, etc. So I think coming out of this on the other side, I do think there is something that needs to happen by way of engagement between the industry and the platforms as to how we can better improve that communication with retail investors without having to go through that formality of this Section 792 notice. And whether that is the platforms pushing out information, and clearly they will want to restrict what it is regarding meetings, but I think that there has to be an improvement there. So far as a general communication with the retail market, speaking for US Growth particularly, our managers do a significant number of podcasts, webinars, speaking at conferences, etc. So we try to engage as much as possible with the retail market, but it is very difficult to get the feedback from them.
So then let's talk about the vote. Let's start with case one, which is what happens if you win the vote, as you say you're confident you're going to do that. What are you going to do next?
Clearly, we'll need to have a conversation with Saba to see if they'll be more open as to what their intentions are. So we will engage with them in the same way as we would engage with other major shareholders. We clearly are speaking to shareholders at present, and we will continue to do that in the months ahead. But the focus needs to be on somehow reducing that Saba holding in a way that doesn't actually disrupt the trust and what it's achieving.
And presumably, if they were to win the vote, tell us your argument why shareholders would be disadvantaged by that. Their involvement has coincided with a reduction in the discount and so on. And as you said, your recent performance until the last 12 months or so has been relatively disappointing after a strong start. So what's at risk here for the shareholders if Saba actually wins this vote?
Well, based on what Saba said so far, I think what shareholders can expect is a very material change to the investment strategy that they have originally bought into. So Saba have indicated that they intend to look to change both the mandate and the manager. They've indicated that they intend to put themselves forward as manager, and that the strategy that they want to pursue is one of investing in UK investment trusts trading on discounts. They currently run an ETF with a similar strategy at the moment, which has substantially underperformed US growth over all but the 3-year period, which was selected by Saba in the requisition. It runs 2 closed-end funds, which trade in New York. Both of those are trading on discounts at present and had sustained discounts under Saba's management. So Saba to be representing that it can do a better job in the discount with its new strategy than, in essence, we've been doing under our strategy, I think is questionable. Linked to that, this is going to be overseen by a board, or at least initially, of 2 directors, one of whom is the founder and CEO of Saba, the other of whom has been nominated by Saba and whose husband was also appointed to one of the US closed-end funds which they manage around about the time they took over the management of it. So we question the independence of the board. That board of 2, and they say they may appoint 1 or more directors, but with no details, they are going to be selecting their fellow board colleagues. So there must be a question about their independence of thought in the people they're going to select. But that board is going to oversee the changes. So you'll end up with a radically different trust than you have at present. And on top of all of that, you got no visibility on what Saba's planning for our private company investments, which, as mentioned earlier, are liquid. So are they planning to sell those quickly? What value can they achieve? As far as we can see, they don't even have experience of managing private company investments. So in effect, Saba's a complete leap into the unknowing of what you're going to get at the end of it.
The question, I guess, that also arises for the investment trust sector generally, but specifically for you and for 1 or 2 others that Saba has targeted, is while in theory the investment trust structure is an ideal one for patient capital, for holding investments for long periods of time and seeing them mature over time, which is the Baillie Gifford philosophy. If you also include, though, private entities in that portfolio, we've seen how, generally speaking, private holdings have been marked down by the market. Do you think that there is, unfortunately, something of a contradiction between this desire to hold private unlisted entities and the risk of discounts widening, which we've seen happen over the last 2 to 3 years? Is that a flaw in the kind of approach that you and other Baillie Gifford trusts have adopted?
No, I don't think there's any flaw in our approach. As demonstrated in our early years, we can trade at a premium, particularly when it's underperformed by strong performance. I think also the nature of the companies we invest in, we're not an early stage investor in the private companies. So there are plenty of touch points against which to benchmark our valuations, whether those are listed companies, additional funding rounds, etc. So I think from that perspective, our portfolio, say, compared to a 100% private equity portfolio, there's greater transparency around our valuations. And I think that the trading at the discount was largely a reflection of that very difficult period of performance.
The fact that we've seen higher interest rates, we had the inflation shock and so on. If you look at the correlations, at least, that appears to be a factor in discounts widening across a wide range of investment trusts. Is that potentially a flaw in the investment trust proposition?
No, inevitably, certain investments are going to be impacted when you have a higher interest rate environment. And the nature of the sector, with particularly the real asset classes, those have been particularly hard hit, so the property and the infrastructure and renewables funds. The purpose of a closed-end fund, though, is to take a long-term view and to be able to hold through those periods of volatility or poor returns. And again, if you look at something like US Growth, our 5-year plus record is very strong. And we've always said to our investors, you should be looking to judge our performance over that longer term period rather than on short term, more volatile performance. So I think it's a perfect vehicle for the more liquid asset classes. But you do need patient investors to see through those periods of weakness.
So if you win, will you continue exactly the same way? Assuming you can deal with the Saba problem once you've dealt with them, do you think there's a case for any change in the approach that you're taking?
Certainly the strategy, we don't envisage any changes there. It's a strategy that's worked well over the long term. Inevitably, we review it at least once a year in detail at our strategy day as to whether there are any refinements that are required there. And that's whether it's round about the processes, the companies we're targeting, etc. The area that we will constantly be keeping under review is if we're trading at a discount, how best do we manage that discount? And what's key to us in that is the feedback we get from our investors, which helps frame the decisions that we make in that regard.
So what I was thinking, obviously, was the level of investment in unlisted companies, 30% or 34% as it was in the last reporting period. That's as high, I think, as you want it to go, but maybe you need to build in some more leeway in future to avoid a risk of this happening again.
We haven't had any feedback from shareholders to that effect that they want us to reduce their exposure. And one of the reasons that we appeal to them is we offer them exposure to companies they can't otherwise access. So that's what makes us unique in our offering in the US space. And it probably is why we were slightly puzzled, again, why Saba was buying us with that private element in there. But if shareholders were to begin to take a different view on risk, then we clearly would need to factor that into our consideration, but we've had no feedback to that effect.
And of course, I guess the other factor in that is that you might see some of your larger holdings, you have quite a concentrated holding of unlisted companies, you might actually see some of them come to market in a better market environment.
That's absolutely right. But we also will then be looking effectively to top up the private company holdings at that stage. We can hold up to 50% at the time of investment in private. We'd never come close to that. And since the original portfolio post-IPO, we've generally been in that 30 to 40% bracket for the privates.
So what would be your final message then to shareholders about this development? You're obviously unhappy with it. You didn't want it, and you so far have not been able to stop them, but this vote is your opportunity. What would be your final message to the shareholders, and maybe also your final message to Saba?
Well, the final message is that we have a great trust here, great performance track record, a unique strategy at a low cost, and a very positive backdrop for future performance. So you can exchange that. If you vote with Saba, you don't really know what you're going to get, except it's going to be overseen by a non-independent board that has been appointed by Saba. What is critical, though, is shareholder democracy, and every vote will count. And I'll put my hands up. I'm not in the past been great about voting holdings unless I'm a director of the company. I will be changing that going forward because every single vote will matter. In our case, we've got about 30% of our register held through the platforms. So they collectively are actually our largest shareholder. And we would encourage all shareholders to vote, irrespective of how they vote, but get out and cast your vote.
So that was Sue Inglis, the Senior Independent Director at Baillie Gifford US Growth, ticker USA, talking to me on Monday, the 13th of January.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.